Everyone is waiting for the moment the Federal Reserve finally says it's time to cut interest rates. Markets are almost begging for it, headlines keep hinting at it, and people are already planning around it like it's guaranteed. But here's the uncomfortable part. What if that moment isn't coming as soon as everyone thinks? What if the Fed is looking at the same economy and seeing something very different from what the market is hoping for? Right now, there's a growing gap between expectation and reality. Investors want rate cuts because lower rates usually mean cheaper borrowing, rising stock prices, and relief for businesses and households. It's the kind of shift that feels like a reset button after a long stretch of high costs. But the Fed isn't in the business of giving the market what it wants. It's in the business of controlling inflation, and that's where things start to get complicated. Inflation was supposed to cool down more smoothly by now. That was the expectation. Rates went up, spending slowed a bit, and prices were expected to follow. And yes, inflation did come down from its peak, but now it's behaving differently. Instead of continuing to drop steadily, it's sticking around at levels that are just high enough to make the Fed uncomfortable. Not high enough to panic, but not low enough to relax either. That middle zone is exactly where policy becomes tricky. The problem is that inflation today isn't just about demand anymore. It's coming from multiple directions at once. Energy prices are creeping back up, partly because of global tensions and around supply. Oil doesn't just affect fuel, it touches transportation, production, and almost everything that moves through the economy. When oil prices rise, it quietly pushes costs higher across the system. That kind of pressure doesn't fade quickly, and the Fed knows it. At the same time, the job market isn't cooling down the way it typically would after aggressive rate hikes. Normally, higher rates slow hiring, reduce wage growth, and ease pressure on prices. But the labor market has remained surprisingly strong. People are still finding jobs, wages are still growing, and that keeps spending alive. From a human perspective, that's good news. From the Fed's perspective, it means demand isn't weakening enough to bring inflation fully under control. This is where expectations start to drift away from reality. Markets are forward-looking. They price in what they think will happen next, not what's happening right now. So when investors see inflation trending lower than before, they jump ahead and assume rate cuts are around the corner. But the Fed moves differently. It doesn't act on hope, it waits for confirmation. It needs to be sure inflation is not just falling, but staying down consistently over time. And there's another layer that most people don't immediately see. The Fed isn't just worried about inflation today, it's worried about inflation coming back tomorrow. If it cuts rates too early, it risks reigniting the very problem it spent years trying to control. That's not just a theoretical risk. History has shown that when central banks ease too soon, inflation can return even stronger, forcing even harsher measures later. The Fed is trying to avoid that exact cycle. On top of that, global uncertainty is adding pressure in ways that are hard to predict. Conflicts, supply disruptions, and shifting trade patterns can all push prices up unexpectedly. These aren't factors the Fed can control directly, but they still influence its decisions. When the world becomes more unstable, the Fed tends to become more cautious. It would rather wait longer than act too soon and regret it. This is why some forecasts are starting to shift. Earlier, there was confidence that rate cuts would begin relatively soon. Now, those timelines are being pushed back, not because the economy is collapsing, but because it isn't cooling fast enough. That's the paradox. The economy is strong enough to delay cuts, but that strength is also what's keeping pressure on prices. For everyday people, this creates a strange kind of tension. Borrowing remains expensive, whether it's for homes, cars, or credit cards. Businesses face higher financing costs, which can slow expansion and hiring decisions over time. And yet, the relief everyone is waiting for keeps getting delayed. It's like standing at a bus stop where the arrival time keeps changing. You know it's coming eventually, but you don't know when. What makes this even more confusing is how quickly sentiment can shift. One month, optimism builds around rate cuts. The next, a few strong economic reports or rising energy prices change the narrative completely. That back and forth creates volatility in markets and uncertainty for everyone else. It's not just about what the Fed will do, it's about how long it will wait before doing it. There's also a psychological side to all of this. When people expect relief, they start behaving as if it's already on the way. Businesses plan investments, consumers make spending decisions, and markets adjust pricing. But if the Fed delays cuts longer than expected, those expectations can unwind quickly. That's when you start to see sharper reactions. Stocks pulling back, borrowing demand weakening, and confidence taking a hit. And then there's the deeper reality that doesn't get talked about enough. The Fed isn't trying to make things easy. It's trying to make things stable. Those are not the same thing. Stability often requires keeping conditions tighter for longer than people are comfortable with. It means accepting short-term pressure to avoid long-term problems. That's a difficult balance, especially when the public is already feeling the strain. So while the market keeps asking, when will rates go down? The Fed is asking a different question entirely. It's asking, are we absolutely sure inflation is under control? Until that answer is a confident yes. Rate cuts remain a possibility, but not a promise. And that's where the real tension lies. The economy hasn't broken enough to force cuts, and inflation hasn't cooled enough to justify them. Everything is stuck in between. And in that space, the Fed is likely to do the one thing markets hate the most. It's going to wait because in the end, cutting rates too early is a mistake you can't easily undo. But waiting a little longer, that's a risk the Fed seems more willing to take, even if it means disappointing everyone who's already counting on relief.